have demonstrated the same by delivering industry-leading margins, which I have already mentioned above. Over the last 3 years, we have continuously paid down our gross debt and have been able to bring down our net debt to EBITDA below 1 at 0.87 at present. In fact, we are adding almost 40% of our existing capacity on the back of our internal accruals while continuing to pay down debt. Capital allocation discipline is of prime importance to us. You will be glad to know that in our current phase of growth, the capacity expansion, both organic and inorganic, is being done at a cost of less than $60 per ton, which is much lower than the cost of current installed capacity of 26.5 million tons, which was created at $84 per ton. This is due to the fact that we acquired Murli and Kalyanpur assets under insolvency and bankruptcy code, and we have created brownfield capacity in East India. During the quarter, we also successfully completed a share buyback, which will entail long-term benefit to all our shareholders by enhancing the EPS in a sustainable manner. We hope to continue and deliver industry-leading performance while having our new capacities up and running with a gradual pick-up in the utilization levels. All this is not possible without the contribution and efforts of a great management team. Over the years, we have strongly worked on building a great team of professionals, and we now have a new addition to that, Rajiv Bansal, who is also there on the call with us. Rajiv is the ex-CFO of DXC Americas, and prior to that, he was the CFO of Ola and Infosys, respectively. On the macro front, while things have improved over the last 2 months on an incremental basis, we are seeing a second wave of COVID sweeping across Europe and America, and we will wait and watch how things will pan out in India. What gives us confidence is the fact that our industry was the first to see a rebound after the initial lockdown relaxations, and we continue to remain cautiously optimistic about the future. I will now hand over the call to Mahendra Singhi ji for his opening comments on the operational performance. Thank you.
Thanks, Punit ji, for leading from the front. Happy morning, friends. It's a great pleasure for me to again welcome you all. I hope you and your family members are staying safe and healthy. So, friends, while we all recognize that the last 7-8 months have been a very testing time for all of us in light of COVID-19 situation, not only in our country but globally. But now we feel, particularly in India, with the onset of the festive season, the homecoming of health, prosperity, and happiness in all our lives. And I wish a very happy festival time, happy Diwali to all of you. At Dalmia, it is our constant endeavor to channelize our efforts and energy into maintaining the highest standards of safety and security of all our stakeholders, including, most importantly, our employees and their family members. And we continue to take all possible measures which enhance their health and well-being. And this philosophy of taking care of all stakeholders has surely helped us in rebooting and recoming back with our operations in a very well established way. Now, moving on to the quarterly results, friends, you must have seen the great performance of our organization, and we could achieve a YOY growth of 7% with a sale of 4.8 million tons. This demand growth is on the back of an exceptional bounce back of demand in eastern states, especially the rural areas, where the south market remained in laggard for most of the quarter. From early September now, we are seeing also some improvements. Our realization on YOY basis has gone up, and if you look at the H1 number also, it has gone up in a substantial way. But now, with this seasonal weakness, especially on account of heavy monsoon in eastern region. We have seen drop on EOQ basis. Further, we have also now added back institutional sale, which was lower in Q1. On that account, also the overall percentage of sales has gone up, and it has impacted to some extent on pricing. We have been able to improve in a big way on variable cost part, and our variable cost has gone down by 14%. And we are quite happy that whatever efforts we have been making while keeping in mind, in focus, the green journey which we have taken long back, is year by year better results. Alongside the favorable commodity pricing, we reap the benefits of some of our strategic initiatives such as usage of green fuel, which increased from 6% in Q2FY21.
Excuse me, sir, I'm so sorry to interrupt, but your audio is it's not
Hello.
very loud, sir. Can you just be seated in one place so that the audio is
No, I'm at one place only. Okay.
All right, you may please continue.
Should I repeat?
If you can please repeat, and I'll just increase the volume. Thank you so much. You may please go ahead.
Friends, sorry for some disturbance on account of some technical matter. I was saying that our variable cost has gone down by 14% on YOY basis, and this has been the result of constant efforts of our team as well as our vision, on account of which we have been able to bring down our carbon footprints, on account of which we could increase share of blended cement, on account of which we could improve cement clinker ratio, and on top of it, we have been also able to increase the usage of green fuel from 6% to 9% in Q2. We are quite focused on taking care of fuel, and we would continue to increase share of green fuel, which will also take care of some increasing cost of petroleum coke or coal. Needless to say, we are monitoring the fixed cost with a razor-sharp focus. Friends, I'm happy to share with you that we achieved our highest ever quarterly EBITDA of rupees 702 crores on an absolute basis. This translates rupees 1,457 rupees per ton EBITDA, which is one of the best for us also. Our finance cost has reduced substantially by 29% to 73 crores, and our PAT has increased sixfold to rupees 232 crores. During the quarter, we have repaid gross debt of rupees 246 crores, and overall in H1 rupees 754 crores. Now, our net debt to EBITDA stands at 0.87. This quarter also was a landmark, as we also successfully completed the share buyback and have bought back 61.66 lakh shares from the market for rupees 329 crores. Total number of fully paid up shares now stands at 18.67 crores. This exercise is expected to give a boost to our EPS on a sustained basis. On capacity enhancement front, I would like to mention, which has already also mentioned by Punitji, that during the quarter we completed the acquisition of Murli Industries under IBC and have discharged already the full consideration of 410 crores. It is expected that the revival of the plant should be completed in 9 to 12 months from the end of last quarter. Our best of the class clinker line of 3 million ton at Odisha has been now commercialized from 1st October. The 2.25 million ton grinding unit at our Bengal grinding unit and 1 million ton debottlenecking at Bokaro is expected to begin trial run production by December 20, and another 2.25 million ton grinding unit in Cuttack at KCW by April 21. As part of the enhancing capacity in East and the efficiency which we have to bring in, we are also adding 30 megawatt of waste heat recovery plant, which we say for green power, which should also be operational by March 22. As you may be aware, our company is the first cement company globally to commit for both RE100 and EP100, which means that we will be using 100% renewable energy by 2030, and hence over the next decade, you can watch us progressively increase the share of renewable energy in form of both solar and WHRS. We are continuing our green journey, and we are continuing with our philosophy of clean and green is profitable and sustainable. Friends, I'll be now happy to open the floor for questions. Thank you and all the best.
Thank you very much. Ladies and gentlemen, we will now begin the question answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Gunjan Prithyani from JP Morgan. Please go ahead.
Yeah, hi. Thanks for taking my questions. Just two questions from my side. Firstly, on this Murli, now that it is under our fold, is there, could you share the capex that you would need to do to bring the plant back into operations, to commission the plant back, and how comfortable are we on the limestone reserves for this asset? And on Murli itself, when does it start to contribute to the volumes? Then I'll get to my second question after this. Thank you.
Thanks. First, we have already now started reviving the Murli plant, and we are expecting that in 9 to 12 months basis, we should be able to start its operation, and that will add value to our overall operations and revenue. We would be investing rupees 400 crore for its revival in maybe 12 to 14 months time, because it will also include some capex on WHRS and something, but we are quite hopeful that we'll be able to complete well in time. Secondly, on mines and limestone reserve part, we are quite confident as well. We are getting full support from the government to augment more and more resources, so that we always feel fully confident of limestone capability to produce regularly from Murli.
Is there anything you can share in terms of how much is the visibility in terms of number of years that we have limestone reserves tied up for? Because that was one concern when this transaction happened. So if you can offer us any comfort around it, it will be great.
I would say that at the moment there is a visibility of 20-25 years, because we know how to source the limestone, and how we know that there are nearby areas also from where also we'll be able to get, so as to add to our limestone reserve. So we are quite confident.
Okay. Just second question, more slightly longer term. Now this basically marks our presence outside of south and east markets. So a new market from that perspective. Now, if we think more from next 3 to 5 years, how should we think about this whole diversification out of the home market? Is it, are we looking to add more in these geographies? And what is, is it a top priority, and how would you pursue this either organic, inorganic? Some thoughts around, this diversification over the next 3 to 5 years.
Yes, I may say that we have one mining lease in MP and one mining lease in Rajasthan. So there we will definitely explore possibilities of putting up green projects, and that may help us in having our presence in North India as well as in Central India. So definitely it's a matter of say 3 to 5 years, but surely we'll have our presence in both these regions.
And how big would be these? Anything you can share at this stage?
It's quite preliminary, but normally these plants are now put up between capacity of 3 million to 5 million, but it's quite preliminary now.
Okay, got it. I'll join back the queue. Thank you.
Thank you.
Thank you. The next question is from the line of Bhumika Nair from IDFC Securities. Please go ahead.
Yeah, good morning, sir, and congratulations on a great set of numbers.
Thank you.
I just wanted to clarify and take forward the previous question in terms of the geographical expansion into North Central markets. As we set up these greenfield capacities or either organic or inorganic over the next couple of years, how do we see, debt kind of moving ahead? We have been seeing a reduction in gross debt levels, but, do we have any, targets in mind to reduce debt further and up to by when and what level? If you can elaborate on that, please.
So one is a long-term measure, say like 3 to 5 years, and we'll be always working with healthy balance sheets. So one should not have concern about debt because of increased capacity, our revenues will go up, our profitability will go up, our cash surplus will go up. So there should not be any concern about debt, and we'll be always working with healthy balance sheet.
Okay. So the next question is to Mr. Dalmia. There has been discussion around, IEX divestment and which has been pending for a while. If you can just kind of, give some clarity on what we are looking at from a perspective of IEX divestment and any timelines to that, as that would be a, significant reduction and help in reduction in the gross debt level.
So look, power and fuel is a significant part of our cost structure, and IEX gives a good understanding of the power markets to us. This investment was made 4 to 5 years back, and it has given us 2.5 times return over the years. Having said that, I want to say that we evaluate our investments on a regular basis. We understand your concern, and be rest assured that we will continue to evaluate this on a continuous basis. It is also important to note that we have not made any such investment in the last so many years. So I think that's all I can offer right now. And I can also say that given the balance sheet, I think we are targeting to be net debt free by end of calendar 2022 or maybe March 23.
Okay, sir. Thanks so much. I'll get back in the queue.
Thank you. The next question is from the line of Indrajit Agarwal from CLSA. Please go ahead.
Hi, good morning, sir. Thank you for taking my question. My first question again is on Morley. So after we have done the capex and revamped the unit, will the cost structure at Morley be similar to our other units, or will it still be at a structural disadvantage? And on the same note, what is the kind of incentives that we can get in Morley?
Yes. So we would get the incentive, and Maharashtra government has already agreed that whatever incentives which was sanctioned, it will be available to us in GST regime also. So they are for next 7 or 8 years. And second, on cost part, definitely in time to come, maybe in 1.5 or 2 years, definitely the cost would be as per Dalmia standard.
Sure. Is there a number on the incentives that this is the rupees million or rupees crore number that has been announced on this?
Maybe Aditya will be able to share offline, but then it's a number which has already been agreed by the government. So we are hopeful of getting it the moment we start selling cement in Maharashtra.
Sure. Thank you. My second question is on the organic capex. So how much is still pending? So I'm trying to understand what kind of capex we can look at for the remaining of FY21 and 22, including the 400 crores for Morley.
Yes. So 400 crore would be incurred, like I said, in next 12 months. But otherwise, the pending expansion capex is about, say, 400 crores for our new capacity in East. And secondly, there will be about 500 crores expansion on various improvement projects, including WHRS.
Sure. One last
Thank
question,
you.
if I may. We have seen healthy working capital release in the first half. So as the economy opens up more and we have better traction on volume, can some of these working capital release reverse, or we can maintain at these levels?
I would say that there will be difference of say 10% or 15% increase, but otherwise it will be all at healthy level.
Sure. Thank you so much. That's all from my side.
Thank you. The next question is from the line of Sumangal Nevatia from Kotak Securities. Please go ahead.
Good morning, everyone. Firstly, congratulations on great set of numbers. We're very impressive on all counts, operations, deleveraging, and concluding the Murli acquisition. And also best wishes to Mr. Bansal for the new role. I have a couple of questions. First, outside of cement, Mr. Dalmia, we hear some buzz on the ground with regards to the group's entry into some retail format. So if you could share some details with regards to that, whether there is any such plan, and if yes, will it have anything to do with Dalmia Bharat, the listed company? And if yes, then what could be the investment time horizon and the vision for that endeavor?
So look, this sector is evolving at a faster pace than most of us can imagine. And we always think of different ways and strategies to stay ahead of the curve. We have discussed multiple ideas with the board over a period of time. And at this point in time, we are thinking about, doing some small experiments, but it will not be prudent to say more given the strategic nature of these initiatives. And, I can only tell you that we are not going to commit large amounts of capital, but we are going to just do small experiments to understand and, figure out, how best to leverage strategic bets which are adjacent and synergistic with our cement business. But this is not going to involve large outlays of capital. It is only going to be very preliminary experimentation.
Understood. So second question is with respect to the East market. The region has quite a strong capacity addition pipeline from the industry perspective. And prices, if we see last few years, have been a bit weaker than the other regions. Although we have been able to maintain our profitability because of our cost initiatives. So any thoughts on how do we see the East market dynamics shaping over the next few years in the medium term?
I will give you my initial comments, but then let Singhi ji answer it. I think overall, we see it as a very attractive market with a very consolidated and a positive industry structure. So, I think the stability in this market is going to be immense. We also see, from a demand supply perspective, utilization levels going up. And East is, one of the few markets in the country where despite COVID, we have seen double-digit demand growth. We also think that this is a relatively poorer part of India in terms of per capita income. And given the mining industry and, focus of government to bring balanced growth across the country, there is going to be, large headroom for demand growth in this area. So demand supply equations will be favorable over the next 3 to 5 years. And also industry structure is great. So we see it as a very attractive market in our portfolio. Mr. Singhi, if you want to add anything to it, please.
I fully agree. And, now the focus of the country and government is to enhance rural economy. And the rural economy percentage in Eastern India is very, very high. And the per capita income of Eastern India is low. On that account, in the next 3 to 5 years, there should be good growth. There are not much capacity additions happening now in the next 3 years, and maybe 1 or 2 plants, including ours. So on that account, we see that there will be good demand-supply balance. For few quarters, there can be pressure on price like what's happening today. But at the same time, the capacity inflation has gone very high in East also. And that's why we see it's a attractive market. It will go on adding value in our overall group.
And Sumangal, Rajiv here. Thank you so much for your wishes. I'm very excited to be part of this, and I'm sure we'll interact more as we go along. Thank you.
Thank you. The next question is from the line of Nitin Bhasin from Ambit Capital. Please go ahead.
Good morning, Puneet and Mr. Singhi. Sir, one question, first to the second two questions. One is that, how do you look at, capital allocation in terms of buyback and brownfield expansion now, Puneet? Because you mentioned in the beginning, and also Singhi mentioned about the buyback. So today, your stock is possibly trading at a material discount to replacement value and possibly closer to brownfield. So do you think with enough capacity right now, don't you think buyback makes more sense today? Or at what valuations will buyback start making more sense for you?
Look, I think, we could clearly see that our stock is undervalued and we announced the buyback. And while we were able to, we were able to deploy 329 crores to it, we still could not complete the full allocation of 500 crores that the board had allocated. So I think, from a capital allocation perspective, we could not even complete the full capital that was allocated to it. We still see that currently we are trading at, probably somewhere around, $65 per ton. And we will continue to look at, the most prudent way of deploying capital from a short-term as well as long-term perspective. So we have a portfolio of projects which are greenfield in nature, brownfield in nature, and debottlenecking of our existing capacities, apart from operational improvement opportunities where we can improve the cost structure further. So I think there is a range of opportunities which we continuously evaluate, and based on our own balance of growth versus profitability and long-term versus short-term, we allocate capital to the best possible projects. So I think, yes, as you can see, that's another option which we continuously explore. But, despite our best efforts, we could not deploy 100% of the capital that was allocated to us. So I think we will still explore it, and, we will, look at the pros and cons of other opportunities which are available and then allocate capital in the most prudent manner, which we think is.
Because if the $60-65 is the new capacity cost and stocks trading at that, pretty much for your own value creation and the shareholders, it makes sense. Anyway, so moving on to the second one, we hear that in Odisha, right now there is a challenge around the Odisha government cancelling all the incentives. Given that you have actually put up a large unit of clinker, an amount of competition that we are seeing with new plants coming over there, both especially south of Odisha, etc. How do you see now the return on capital employed of that investment? Will it be very, very low and loss-making for the next 2-3 years?
Look, Nitin, this investment is a brownfield investment and is created at a cost of, $60-70 per ton.
Yes.
We are never dependent on government incentives to get return on our projects. That's only a kicker and a cherry on the pie. So I think with or without incentives, these investments are hugely viable. And as I told you that Odisha plants are running at very high capacity utilization. So we expect the new project to be accretive right from year one. And also this is going to be the lowest cost line in the portfolio of Dalmia. So, not just the capital cost is low, but even the operating cost curve is going to be the lowest. So we are extremely competitive, and it's in our home market. It's in a place where we understand distribution, where our brand is well established. So the risk to this, project, being accretive is very, very low.
But the incentive going away will create challenges for competition then? It helps you because possibly they were more relying on competition. How does it?
Look, I don't know how competition allocates capital. That's for them to decide. But I can only say that, for us, we have a very strong position in this market. Our cost curve is one of the best in the industry. Our brand is very well established, and our distribution network is very excited about this new project. And we are going to scale this up, based on demand supply fairly quickly. And this is going to give returns, quite fast, given the fact that, the investment is not very high.
So Puneet, now in the next 10 years, how are you thinking of capacity increase? Given the last 10 years was 3 times, 3.26 times. Next 10 years, how are you thinking given the scale that you have, opportunity landscape that you see, balance sheet that you see? Do you think again it's an opportunity to become 3 to 4 times in the next 10 years? Because you have also an added target of adding a massive renewable energy by the end of the decade. So that might increase the cost of capacities that you create over the next 10 years, and a lot of greenfields might come. That's it from me. Thank you.
So look, I can't give any specific guidance on that because the board, continuously evaluates investment opportunities and approves them. But all I can say is that we will continue to deliver growth which is faster than the industry. We have a strong track record of last 15 years in growing capacity in high teens and growing our EBITDA in also high teens. So I think at that time, we were a smaller company with less management resources, less capital, and smaller footprint. I think given the fact that we have more strength now in all areas, whether it's people, capital, or the footprint and the infrastructure that we have, I think we can reasonably expect to perform on a similar basis in the coming decade as well.
Sure. Okay. Thank you.
Thank you. The next question is from the line of Bhavin Chheda from Enam Holding. Please go ahead.
Good morning, sir. Congrats, Puneet Singhi, and for the excellent performance and the way you are deleveraging the balance sheet, and also now almost the lowest variable cost in the country. So it's very good to say it. And welcome, Mr. Bansal, to the team. Just a few questions. First is on the lead distance, what it would be for the company, and post expansion and completion. Obviously, now the company is heading for double-digit growth. So what would be the outlook on the lead distance? Second question is, recently the petcoke prices have seen a spike. So what would have been the current fuel mix, and how we will keep changing it so that our costs remain under control? Yeah, thanks a lot. Yeah.
Okay. So one, we have already laid down our strategy by which the new volume which would be coming up in East would be sold in the same market area where we are operating, and that's why we don't see much increase in lead distance, on account of which it may be having some impact on logistic costs. So that's already laid down the strategy. So we are quite confident about that. And on this second question, that was in regard to fuel. So one, I would like to say that all our plants are compatible to use any economic fuel. So whether it's a petroleum coal, whether it's a high moisture coal like Indonesian coal or South African coal or lignite, and at the same time, recently we have also made our plants ready to use alternate fuel, which is green fuel. So now, like in this quarter also, after seeing that there's an increase in petcoke prices from say $70 to maybe $95, $98, we have already to some extent have switched over to Indonesian coal and South African coal. As well as a long-term strategy, we have identified that we will go on using more and more green fuel with the proper strategy and proper operations. And another point is that to some extent now, the Indian coal is also becoming economical in some parts of the country, as Indian government is also looking at enhancing the production and sale of Indian coal, this imported coal. So to that extent, I would say that all our plants are compatible to use any economic fuel, and we will go on switching for that.
Yeah, and what would be the lead distance in kilometers?
Exactly, it may be about 270 or 280, but then definitely it can be further confirmed.
It is below 300. It's about 290.
Yes. Okay.
Okay, thank you. Yeah.
Thank you. The next question is from the line of Madhav Mehta from Fidelity Investment. Please go ahead.
Yeah, hi. Good morning. Thank you so much for your time. I have two questions. My first one was, Dalmia has, anyways been at the forefront of scaling up the green power and fuel mix. I just wanted to understand what the current power mix for us is from green sources like solar power and WHRS, and next 5 to 10 years, where can that mix move towards as we scale up capacities as well?
Yes. So So presently, I would say, including WHRS, which we have recently installed, and 3 solar power plants which we have with us, the overall percentage would be 7 to 8%. And in addition to this, we are also buying green power from IEX to some extent. And thirdly, we have now the system that wherever there is a IEX power available, which is lesser than even our own captive power generation cost or grid cost, we are buying that. And we have now the specific plan that in next 5 years and in next 10 years, how things would pan up, so that we go on increasing percentage of renewable power, which also includes WHRS. And by 2030, we are quite hopeful, because you must have also seen that the cost of putting up solar power plant is going down, and it will further go down, and that will make sense in investing our funds capital shortly in solar power also.
Okay. So the current power mix is 8% from WHRS solar power. Any number that we're targeting in the next 5 years that we want to use?
Yes, it may happen maybe 35 or 40%. We are targeting that part in next 5 years.
Okay. And so, just follow-up to this question was, given that I think the larger companies in the cement space are investing on the power mix because they have the balance sheet to do so, do you think this will create like a cost advantage for us, at least for the next 5-10 years, versus the smaller companies who probably can't invest as fast as us? And as a result, sort of expands the margins for maybe the larger companies in the next 5 years? Is that a fair way to think?
I would say, as per our company's philosophy and as well our commitment, that we have to invest in green power so that we remain competitive, as well as we go on reducing carbon footprints. So we will go on investing, and if other companies who don't have strong balance sheet, if they don't do that, then they may be at disadvantageous position, because it's time now that each and every company, not only cement company, but other companies, should also invest in green power.
Understood. And my second question was, just wanted to welcome Mr. Bansal to the team. I was just very curious that he's coming from, to a more traditional industries from Infosys and Ola. I just wanted to know his thoughts on what gets him here. Maybe it's a slightly off-beat question, but just curious to know.
Yes, he would surely reply, but I would say, having met him and having understood him, he is a versatile personality, and he has the capability to understand each and every type of industry, each and every type of working, and he has also worked earlier in manufacturing company also, but of course he has added great values in various IT companies, and maybe Rajiv can also share his thought. Rajiv?
Yes, and Singhi, actually there was a problem in the audio, so I couldn't hear some part of it in the middle.
No, should I repeat my question, sir?
Yeah, please do.
Yeah. No, I was just curious to understand what brings you to a more traditional industry versus Ola and Infosys, where you worked in the past. Just curious to know your thoughts there.
And Rajiv, I just said that Rajiv is a versatile personality, and whatever we have understood, that he can take care of any type of industry, and at the same time he has a great experience, mixed experience of manufacturing also, IT company also, and finance companies also. Yeah. Yes, Rajiv.
Thank you, Singhi. So, I have been with different industries. I started my career with power generation, to telecom, to IT, to internet. The way I look at it is, it's a great opportunity in the country for a company like Dalmia Bharat, right? Given the country is growing at a very fast pace. With the post-COVID, the government needs to accelerate the economic development and economic growth. I do expect infrastructure spending to increase. I do expect the capital cycle to come up very soon. And companies like Dalmia Bharat would definitely be on the forefront of that. And even from the company perspective, given that there's a huge opportunity in the marketplace, the company has a great potential. Look at the capital addition over the last 2 decades. a great vision. I think Puneet has great plans and great vision for the company. Singhi ji is, has this amazing strategic thinking. He's a kind of veteran in this industry. He knows the industry better than anybody else. It's a great leadership team. So, it's a great opportunity in the marketplace. It's a great potential that I saw in the company, a great leadership team. And, and from my perspective, I think it's not about the new economy and old economy. I think that over a period of time, everything is going to get more technologically advanced. And, it's to create value for all stakeholders. And I see a huge potential to create value in this company and in the sector. And that's the reason I'm here. And we will discuss more when we meet in person.
Definitely. Thanks.
Thank you.
Thank you. The next question is from the line of Ritesh Shah from Investec Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. Couple of questions. Puneet, you did indicate about incremental capital allocation and projects being accretive from year one. So would it be possible if you could provide some numbers over here? How should one look at it when we decide upon incremental capital allocation? If you could put some numbers on ROC or payback, that would be great. That's the first question.
No, I mean, as I said, we always look to make returns over our cost of capital. And right now, if I look at a cost of debt capital, it is 7%. We target return on a long-term basis in equities, in the mid-teens, say 15-17% return on equity. So I think any project that generates a return which is more than a cost of capital, we like to invest in. Having said that, I think in the IBC situation, we saw distress in the market. We did not see too many buyers. So I think we were able to pick up some assets, at a very attractive price. And I think for those projects, the return could be, in the high teens or the mid 20s also. But overall, I think we have many investment projects which will create growth, and some of them, are more long term if we enter new markets. Like Singhi was saying, if there are, greenfield projects, they are more long-term in nature. They may not give immediate returns, but over the, tenure of the investment, which is our time horizon could be anywhere between 7 to 10 years. I think even those projects yield the returns that we normally target. Over and above that, I think we have a portfolio of cost improvement projects, and in those projects currently we are targeting a return of 4 to 5 years payback. So I think it varies depending upon the strategic objectives, because in some markets you may have to take position which may not be attractive short term, but it will be very attractive long term. And we already have an entry license into those markets with the mining lease. But in some markets where we already are present, they are very attractive opportunities because we are established, cost structure is low, investment is low, and it can give immediate returns. So I think overall on a portfolio basis, whether it is brownfield or greenfield or cost improvement projects, I think we target returns in the mid-teens.
That's useful. Just a related question. I think in one of the prior questions it was said that Odisha government is not giving out incentives. Could you just confirm on that? And if you could provide some color on what's the status on incentives specifically for Bengal, Bokaro, and Bihar as well. This is more from our forecasting purpose rather than gauging it from a ROC point of view. It will help us guys from a forecasting point of view. That's a related question.
I think Aditi can take it offline, or if Singhi ji, you have some numbers in your mind, you can share it. Otherwise, Aditi can share the numbers with you.
I think she can take up offline.
Perfect. And my second question is for Singhi ji, sir. We have laid a very bold target on carbon negative cement growth by 2040. Again, so what gives us the confidence over here, given carbon sequestration or carbon storage? It is still something which is quite not proven, or on a large scale. Cost economics is something which is still a question mark. So what gives us confidence, and how should one look at it from a capital allocation point of view when we have laid out such bold targets? Thank you.
Yes. Our operation thinks for future. We have the capability to visualize the future, and that's why we offer cement also with the tagline "Future Today." In fact, we could visualize that ultimately, whoever is able to bring down carbon footprints, they would be also able to bring down their cost and at the same time, they would also be supporting the globe and the community. So with that, we have kept our vision in mind. At the same time, always we'll be working with the philosophy of clean and green is profitable and sustainable. So when we go for investments in renewable energy, then you would find that we are bringing down our cost of power. When we bring down the usage of fossil fuel and goes up with green fuel, then also you'll find that it is bringing down the cost of fuel. Similarly, when we are able to capture carbon dioxide and are able to use it as a raw material for other sectors, then also we are making one cost down, and at the same time also taking away the CO2 of other sectors, by which we will be carbon negative. Now, the good part is that the initiative which we took on carbon capture utilization, so Asian Development Bank has already now started feasibility report on the same. And lastly, I would say many of the investment would also be covered by the international carbon market, and that is going to start in 2 to 3 years' time. So when we are ready, so we'll be having the advantage of first mover because we'll have the project ready. We'll be able to offer our carbon reduction part for the carbon market. And this is how we are visualizing overall scenario. And we are quite confident. That we'll be able to do it. And you will find that many of the groups, not only in cement but other groups also, are following and would be declaring that they will be carbon neutral maybe by 2040, 2050, 2060. But that's the trend which is in the interest of each and everyone. Thank you.
Thank you. The next question is from the line of Amit Jain from Samson AMC. Please go ahead.
Yeah, hi. Thanks for taking my question. My question is for Puneet. I want to get a sense, you spoke about that by FY23 we target to be net debt positive, net debt neutral. The question is, do you want to stay that way as you think over the next 5-10 years, or in our quest to sort of grow mid-teens in terms of capacity, you look at adding on debt again? So just want to check, like on a longer term basis, what sort of debt are you happy to have on the balance sheet?
Look, as I said earlier as well, I mean, having some debt always improves, equity returns. So I think if you have zero debt on the balance sheet, that's perhaps not the best use of capital. And I think we have to create investment pipeline in terms of projects, whether it is operations improvement or, new expansion projects, given that balance sheet is going to be very strong. But I think on a sustainable basis, somewhere in the region of between 2 to 3 times EBITDA is something that we are comfortable with. Net debt to EBITDA of between 2 and 3.
All right. Thank you.
Thank you. The next question is from the line of Swagata Ghosh from Franklin Templeton. Please go ahead.
Yeah, thanks for taking my question. First, a housekeeping one. What was the incentive number for this quarter?
Hello. We accrued about 21 crores this quarter.
Sorry, 21?
21.
Okay. And second question to Mr. Dalmia, clarification on the IEX bit. So, did you mean that you will evaluate various factors and then take a call on the liquidation of that investment? And if so, what would be those factors be?
No, I already told you that we are looking at we continuously evaluate all our investment opportunities, and if we think that we have better way to deploy our capital, we will basically recycle this capital. So I think it just has to be a rational decision with no emotions. I think that's how we will look at it, and we will be just prudent about it.
Okay. But is this still a thinking in terms of non-core and core investments? And if so, then it would
I
certainly
think, look,
fit in
this
non-core.
investment was made 5 years ago through a power company when the cement and power company were separate. So it was a very core investment to the power company because at that time we thought it's a better way to play the power sector as opposed to putting greenfield projects. We wanted to do it. We thought exchange is a much better and more attractive opportunity, and our thesis has played out. Not just have we made very good dividend returns, which are around 6-7% on the capital that we've invested, but it's also given us appreciation of capital of about 2.5x. Having said that, I think we will continuously look at whether we are the best holders of this asset right now or not, and compare it with other investment opportunities that we have. So we'll look at what growth do we expect in this asset and by when, and what are the competing claims on our capital. And based on that, we will take the best decision that makes sense.
Got it. That's helpful. And the last question on the East India expansion. So we have our capacities coming up online. But in a scenario where the overall market growth does not sustain, I'm just curious to understand what would be a ramp-up strategy. Currently, as I understand, the growth is pretty strong. But if it in case it tapers off, would there be a delay in a ramp-up, or would we still be aggressive in ramping up our capacity?
East is expected to grow, and some compressor in demand maybe for a month or 2 or 3, and and we are not playing any short-term games. So we'll go with our strategy that yes, we have the capability of our brand, we have the capability of lower costs, so we will be able to ramp up as per our strategy.
Okay, thank you.
Thank you. The next question is from the line of Gaurav Rateria from Morgan Stanley. Please go ahead.
Hey, thank you for taking my question, sir. 2 questions. Firstly, the capacity in East is almost doubling. So if the market conditions prevail what it is right now in terms of demand, how much time would it take to bring the new capacity to a similar utilization rate as your current capacity is there in the market?
It may be 1.5 to 2 years, maybe 2 years time maximum.
Okay. Secondly, sir, you talked about the cost curve being one of the lowest for the new capacity. Would it be possible to get some numbers where the East market profitability stands today, and how much lower on the cost would be the new capacity versus the current cost structure?
So I would say if we look at the utilization part, then definitely because of our very high efficient pyro process, the fuel consumption would be in the range of say 670, 680. Power consumption would also be lower, maybe 45, 48 units. So accordingly, as per the price of fuel and power, it will be lower than the existing one.
Okay, sorry. Last question on the minimum cash balance which you would like to keep on the balance sheet, because I think this first half you liquidated certain investments to pay off the gross debt quite aggressively. So is there a rethink on the minimum cash balance you would want to keep on the balance sheet? Thank you.
There is no aggressiveness or something. It is all with our planning and strategy. And since we have been able to generate good profits, so we have already repaid those debts, and the same strategy would continue.
Thank you.
Thank you. The next question is from the line of Amit Murarka from Motilal Oswal. Please go ahead.
Yeah, hi. Good morning, everyone. So my question again is on the expansions. So like how Puneet mentioned about the net debt EBITDA being comfortable at 2 to 3x, and given that I think you are on track to get under, almost get neutral maybe in the next 15 to 18 months. Is there any thought on fast tracking the North and the MP limestone? These anyways will take 2 to 3 years to develop. So can we expect any steps towards that maybe by end of next fiscal? That was the first question.
So I would say that we have already started some startup green field activities, and maybe in the next 6 to 9 months we'll be further able to give the visibility.
Okay, sure. And also on this, when you enter new markets, because generally, I mean, this West actually is a completely new market in that sense.
Sorry?
I was saying that when you enter new markets, as you're doing in West, what is the strategy to go about expanding or catering volumes in that region? Like, will it first be through non-trade routes, or is there a distribution network already being planned?
We have already planned out our strategy, and it cannot be prudent to spell out whole strategy in this call. But at the same time, we are quite confident that we'll be able to sell a full volume of modeling. And we otherwise also we are fully aware of this market.
Okay. And what was the share of trade sales in this quarter?
Share of the trade would 70%?
68%.
Yeah, 68%.
Okay, sure. Thank you.
Thank you.
Thank you. Well, ladies and gentlemen, we take the last question from the line of Abdul Fateh from Baroda Mutual Fund. Please go ahead. Mr. Abdul Fateh, your line is unmuted. Please go ahead with your question, sir. Mr. Abdul Fateh, your line is unmuted. You may please go ahead with your question. As there's no response.
Hello. Can you hear me?
Yes, sir. Please go
Yeah.
ahead.
So in reply to one of the earlier questions which was asked by Sumangal, you said that the investments in the new retail venture that is flowing out will be experimental and small in nature. My question is whether this retail venture would be in the existing Dalmia Bharat company and the capital would be provided by Dalmia Bharat, or it would be in a separate company at the promoter's level.
So it will be part of our Dalmia Bharat company.
Okay. And the capital would be provided by Dalmia Bharat.
Naturally.
Thank you.
We take the last question from the line of Kamlesh Pangmar from Prabhudas Lilladher. Please go ahead.
Yeah, thanks, sir. Just one question on the part of this, some media reports that were there that in Kalburgi we are looking to invest. So what would be the priority? Would it be like, say, MP or North market, or to expand in the southern market?
So we are exploring possibilities of expanding our capacity in Karnataka. So government is coming out with some new proposals for investors, and we are exploring that.
And so lastly, like on just was going through your sustainability report and annual report as well. So we have done phenomenal job on the power consumption side. But on the specific energy consumption, we are at like around 797 or 800 kilocal per kg of clinker. I do know that last year we had like say trial runs of new kiln at Odisha. But even before that, like say, it has been in the range of 770, 780 levels, which is by far like say highest in the industry. So any thoughts on bringing down that particular consumption levels?
Yes. So because of Kalyanpur Cement DDSPL, that heat consumption had gone up, and now we have already done the moderation. So maybe in 2 quarters' time, we'll be able to see the positive impact of that. Secondly, we have also taken up various projects on heat consumption improvement parts, so that result would also be evident. And thirdly, with this now commercialized operations startup of line 3 of East, we should be able to see the lower number of heat consumption in totality by March end.
And so what are the utilization levels currently at new kiln, sir?
So which one?
The new kiln which has come up at Odisha.
Yes. So now it will be 70% to 80%.
Okay. Thanks, sir. Thanks a lot, sir.
Thank you.
So does that answer your question?
Yeah. Thanks.
Thank you. Well, ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Dalmia for closing comments.
Thank you very much, everybody, for your participation on the call. Again, I wish all of you and your families a safe and healthy time. And once again, thank you for all your support and for feedback for growing this company. And thank you for being, patient investors with us. We really appreciate it. Have a great day, and look forward to connecting with you, later. Thank you. Bye.
Thank you. Ladies and gentlemen, on behalf of Dalmia Bharat Limited, this concludes this conference. Thank you all for joining. You may now disconnect your lines.